Well, today we're going to talk about the Retirement Income Review, and we're joined by one of my favourite people on Twitter, I have to admit, Stephen Koukoulas, Managing Director of Market Economics. Hi, Stephen.
Good morning. How are you, Tracey?
I'm really well. Now, what does the review mean for any future potential rises in the superannuation guarantee?
Well, it's putting future rises at risk. Now, they've come out with an analysis on superannuation policy. They haven't put in firm recommendations that will automatically taken up by the government. There is a consultation process going on right now, and so we'll wait and see whether the government actually embraces them. But it does come up with ammunition, if you like, for the government, who is dead against superannuation, to pare back or postpone the currently legislated increases in the superannuation payment. And they're saying that there is a trade-off between wage increases and superannuation increases. They are saying that there is a significant cost to the budget because, of course, if wages don't go up as much, there's less income tax going to the government. So there are a couple of excuses that they're using. A different analysis suggests that they are not the be-all and end-all of analysis of superannuation, because the cost of the budget is being at least partly, if not fully, offset by accumulation in our superannuation balances. And there's no hard evidence that the superannuation guarantee rise over recent decades has coincided with weaker wages growth. In fact, on the contrary, the current period of very weak wages growth has occurred when there's been no increases in the superannuation guarantee charge.
Let's dig a bit deeper on that, because both the Reserve Bank Governor and the Grattan Institute say there is a trade-off between a person's present wages and the superannuation guarantee. Are they both just plain wrong in your eyes?
They're selectively looking at data. I think that's the problem when it comes to the superannuation guarantee charge, and it is a very, very complex issue. I think that what they are perhaps overlooking, or perhaps de-emphasising, they're focusing on just the super increase versus wage increases, is that there are many issues that drive wages growth. It's not just the superannuation guarantee, of course. It is the skill set of our workforce that's important for determining wages. You know, we're even hearing now, when we've got very large numbers of unemployed, that we've got skill shortages in Australia. Gosh, who would have thought that? It's because that we perhaps don't have the skill set of our workforce, that those people who are unemployed don't have the skill set or the wherewithal to go and do this work that some employers are saying they're finding difficulty attracting the workers. That's part of the issue. We also know that a strong economy is very important for wage increases. And this last decade or so, when we've had wages lucky to be increasing at 2% per annum, has coincided with what's been a sluggish economy. That from the global financial crisis 10, 11, 12 years ago now, through to the onset of the COVID-19 recession, which we slowly getting out of right now, has meant that there's been not a lot of ability of workers to get pay increases. And then, of course, there's this other issue, which I think Grattan and the RBA governor are overlooking, is the rapid move to the gig economy. That we're seeing a lot of workers undertaking little bits of work here and there. They don't have that old-fashioned, if you like, 40 hours a week with sick leave and these sorts of things. That they're doing this gig economy work, and that in fact is undermining their terms and conditions of employment, including their pay rates and including the superannuation that they're receiving.
You mentioned the sluggish economy just then. Is a rise in the superannuation guarantee affordable during these tough economic times, particularly for business and especially for small business?
Look, I think it is. We've got to sort of disaggregate what is still only going to be a temporary hit to our economy. The COVID recession will end soon. I don't know exactly when, and I don't know quite the circumstances, but it's not a permanent problem with our economy. It might be a year, it may even be 2 years. I'll be pessimistic and say the last 2 years, but we will recover. The economy will recover from this COVID-19, and already we're hearing Qantas, gearing up for 100% of their pre-COVID domestic capacity by early next year. So we're going to be having lots of domestic tourism as an example of how our economy is recovering. Superannuation is a long-run structural issue. So are we going to hit superannuation on the head to fix a 2-year economic problem? That superannuation is about young people now entering the workforce, and so that when they hit retirement age at the age of 65 or 67 or whatever it's going to be, when they do retire, having a decent retirement income so that they can live in reasonable comfort over that time. If you start chipping away at superannuation now, you have a problem in 30 and 40 and 50 years' time. You may have that band-aid solution to the economy now, but I prefer to think that you can use fiscal policy, JobKeeper, job seeker payments, infrastructure spending to fix the economy now. Let super increase, because that's going to be still an absolutely essential part of our ageing population, which of course is the dominant issue behind superannuation.
Of course, the review didn't only look at superannuation, it also looked at things like pensioners' homes. And the review said there could be a cap on the value of pensioners' homes above the median price to, quote, reduce inequitable outcomes. How likely is any government to do this, given the expected electoral backlash?
You summed it up perfectly. The electoral backlash makes it just about impossible to include the family home. With my strict economist's cap on for a moment, it is absolutely essential that we do include the family home, because we do know of many examples of what we call the asset rich, income poor retirees. They may have bought their house 50 years ago for $25,000 and it's now worth $1.5 million, or in some cases even more. So, but nonetheless, they don't have a lot of assets to give them an income. So in a sense, there's this discussion in the paper that was released on super and retirement incomes that says, well, perhaps people should be withdrawing cash from the old house. So how do you do that, of course, is the big question. There are things like reverse mortgages that people can withdraw a little bit of money out of the value of their house. And so when they pass away, whatever debt has been accumulated is taken out of the estate. So for the beneficiaries of the estate, they may not be quite so happy, but it actually gives the older person some dignity and some financial security in retirement. So that's one thing that can happen. There's also a bit of discussion about whether we have the age pension like HECS, the higher education contributions scheme, where if you get a pension over and above the basic pension that's being paid, again, you accumulate that, and after certain thresholds and means testing, of course, that is paid out of the estate when you pass away. So there's things that you can do to sort of free up that wealth that so many retirees have in their house, but they can't at this stage easily access it to give them a decent income in their retirement. Politically, oh gosh, I don't think either side will touch that with a barge pole, unfortunately.
Stephen Koukoulas, thank you so much for your insights.
Thank you.